If you could sit down with two legends of personal finance at the same time, would that help you make better financial decisions? And if so, what would you ask them? Well, Dave Ramsey and Robert Kiyosaki are arguably the biggest names in personal finance, and I'm going to bring their biggest lessons. I'm going to compare them against each other, and I'm going to give you what I think is the best of both worlds. We're going to look at what their investing strategies are. We're going to look at how they both approach risk and how you should think about both depending on where you sit on this spectrum. We're going to talk about why they disagree with each other, and there's been some hard words exchanged.
Dave Ramsey's a idiot, that's why.
Make sure you buckle up, buckle in, I should say, and let's get going. So the two titans of business, investing, finance that I want to talk about today are Dave Ramsey and Robert Kiyosaki. All right. Now, Dave Ramsey and Robert Kiyosaki, like I said, are arguably, I don't even know if it's arguably, I mean, they're pretty much the biggest names. Robert Kiyosaki has written numerous bestsellers. Of course, his main book is The Rich Dad, Poor Dad, which was written over 25 years ago. It's one of the best-selling books of all time. It's a book that really influenced my life and put my life, I'd say it's probably one of the maybe two or three most influential books on my business and investing career. So there's other books on other topics, but certainly for business, investing, finance, Robert Kiyosaki's Rich Dad Poor Dad is probably the most influential. And then, of course, we have Dave Ramsey, who has sort of taken over the world on radio, and now he's big on podcasts and YouTube as well. And he also takes a different approach on how to build wealth and how to get out of debt and things like that. All right, so Robert Kiyosaki and Dave Ramsey. Now, they sit on opposite spectrums, and like I said, there's been some hard words exchanged back and forth here. So let's break this down. So the first thing I want to do is we'll just look at Dave Ramsey and sort of a high-level overview of what his approach is. We'll look at Robert Kiyosaki's, then we'll dig deep into those and let you know the differences and how you should think through this. Okay, so obviously, we start with Dave Ramsey. Alphabetically, he goes first, but he has a very debt-averse approach. All right, so he's renowned for his, his views of basically don't take on debt, get out of debt as fast as you can. He advocates for aggressively paying off any debts that you have, and that you should be building wealth through savings. Building wealth through savings and investments, and he likes to put people into mutual funds. All right, we're going to dig into this, but we're just going to keep going. He's very conservative when it comes to investing. So again, very risk averse. So he's debt averse. He's also very averse to any risk in investing. So he wants to be very conservative. He recommends using very conservative investment strategies, focusing on mutual funds, and avoiding riskier ventures like individual stocks, like picking stocks, picking sectors, or real estate speculation. He's not a fan of that at all. He's sort of known for these 7 baby steps, very well-known plan. That's what he's known for, which basically is like a methodical, it's a systematic way to provide financial stability. We're going to go through those 7 steps, but basically it starts from creating an emergency fund to investing up to 15% of your household income in retirement accounts, which I think is pretty good. Obviously, all wealth comes from savings first. So you have to make money, you have to spend less than you earn, so you have some savings, and then you need to invest that savings for growth. He thinks you should be investing 15%. Grant Cardone says that you should be investing 40% of your wealth. Now, some of you might say, well, I can't invest 15%. I don't make that much money, or I can't invest 40% like Grant Cardone. I don't make that much money. Well, you can, 1, make more money, or 2, you can cut your expenses down, and of course, you can do both of those things. We're going to come back to that. All right, now, framing up Robert Kiyosaki's philosophies, sort of like his overview. We're going to dig deep into these. I want to break them down. But he's into using debt. And as a matter of fact, he likes to leverage debt. So it's an, exact opposite view of what Dave Ramsey is. The author of The Rich Dad, Poor Dad views debt as a tool for wealth creation, and he encourages using debt, particularly in real estate. Now, I do want to say, Robert Kiyosaki talks about good debt versus bad debt. There is certainly bad debt, and he frames that up. We'll talk about this in a minute. And he says avoid that at all costs. So sort of he's in agreement with Dave Ramsey on bad debt, but Robert Kiyosaki believes there's good debt, and Dave Ramsey doesn't make that distinction. Robert Kiyosaki talks about building assets. So his strategy revolves around generating or building assets, specifically assets that generate income. He also believes in financial education to understand what you're doing. I like to say that if you don't have an edge in the market, then you're not going to succeed, right? You don't have an edge in just public utilities or private equities, I should say. Let me reframe that. You don't have an edge in public equities in the stock market. The high-frequency traders in Wall Street, they have an edge. You don't. But we can pick up our edges in other areas, but a lot of that comes from our own education. We're going to come back to that. But if you don't know what your edge is, that means you don't have one. And if you don't have one, you probably shouldn't be investing. If you don't know what you're doing, you shouldn't be investing. A lot of times people ask me, Mark, what should I do? It's like, well, if you don't know, you probably shouldn't do anything because it's too much risk. It's like I use surfing as an analogy all the time because I'm a surfer from Southern California. If you showed up to Pipeline in Hawaii where the wave's 30 feet tall and it breaks on just 4 or 5 feet of water, and you might say, Mark, I'm not sure how to paddle out and catch one of those waves. Tell me what to do. No, the answer is no. Do not paddle out and try to catch one of those waves if you don't know what to do. And so you start small in very small waves and very, soft bottoms, let's say with sand bottoms, and you work your way up. Okay, so you wouldn't show up to a Pipeline and say, how do I paddle out and catch a wave? And you shouldn't ask that with investing either, specifically when it comes to more complex strategies, which we'll talk about. Also, Kiyosaki likes diverse investments, unlike Dave Ramsey, which says just put it in mutual funds. He likes to diversify his investment approach, including real estate and businesses and some commodities. We're going to talk about the core differences there. And like I said, there's just a very stark contrast, right? Ramsey is don't use debt. Have a very, very conservative path to investing. And Robert Kiyosaki on the other side is an advocate of using debt, an advocate of using a few different asset classes. And, both people have had massive success. But I want to point out the difference here. Kiyosaki urges or advocates you using debt and building assets. Specifically, he likes real estate, some commodities, and gold. He's been a big proponent of gold, commodities, real estate, and businesses. Dave Ramsey says, save your money and invest it into mutual funds and don't use debt. But both of them really built their wealth through businesses. See, Kiyosaki tells you to invest into businesses, and Kiyosaki has businesses, and his businesses have made him a lot of money. Whereas Dave Ramsey made his money in businesses, but he's not telling you to invest into businesses. So there's a pretty big difference there. We're going to come back to that. So let's start with Dave Ramsey again, alphabetically. He's a D. He starts first. And let's look at his process and his really approach to risk. Now, he has 7 steps. And really, again, he promotes a very risk-free, risk-averse strategy, avoiding debt, focus on mutual funds. And really, this is suitable for those who really want to prioritize security and are not really worried about returns. Now, one thing that I do like about this is that we'll get into diversification, but if you don't really focus on investing, you don't use debt, all you do is earn money, save it, and stick it away into mutual funds. I don't think it's the best way to do it, but it allows you a lot of extra time that you could just focus back on your business and making money. You see, when you start to diversify, when you have to start to learn about all these different stocks, different commodities, different trading strategies, cryptocurrencies, etc., it takes away a lot of time, energy, effort, and focus that you could just be spent focusing on your business or your income to get your income higher. Remember, we talked about saving 15 to 40% of your income. And so maybe some of you need to make more income. And so if you're not worried about all this investing, you can do that. So to Dave Ramsey, let's give him a win on that side. He makes it very simple so you can just focus on making money. Now, he doesn't talk about that specifically. We're going to come back to that. And again, Robert Kiyosaki encourages taking calculated risk-taking. I want to say calculated. He definitely makes the difference between good debt and bad debt. But he argues that if you use proper risk-taking because you have used education to educate yourself to de-risk the situation, going back to surfing Pipeline in Hawaii, if you, someone who's never surfed before, were to paddle out there, you would probably die. But yet, at the time of this recording, right now they're running a contest at Pipeline, and those guys surf over there all the time, and really nobody ever dies. Because through their education, or I should say through their experience, they've been able to de-risk that situation. You see, risk is always in the investor and not the investment. So if you went to go surf Pipeline in Hawaii, the risk would be on you, not the wave. I mean, sure, the wave's risky, but through that education and through that training and through that experience, they have de-risked the situation. All right, and if you're able to do that, you get higher returns. All right, so let's break this down. Now, a key piece here we're going to come back to is businesses, real estate, and taxes. All right, so we're going to break that down. Now, I do want to say just real quick, something I've been talking about is a reverse market crash. You've been hearing me talk about this lately. Everyone's been afraid of a market crash for the last 2 years, but the market keeps going higher and higher and higher. But there's two types of crashes. There's a crash where things go down, but there's also a crash where things go up. Now, when it goes up, a reverse market crash is actually worse in the long run for most people. But for those of us that take advantage of it, it is our opportunity of a lifetime. And I'm having a live presentation. We're going to break this whole reverse market crash down. I got about 30 charts I want to show you. So we're going to do it live. I'm going to show you the charts. I'm going to show you exactly what I'm doing about it. 3 different asset categories that I think are the ones we want to be in this reverse crash. If you want to check it out, go to go.onemarkmoss.com/reverse. Again, go.onemarkmoss.com/reverse. It's free. Come hang out with me, check out the presentation, and I'll answer all your questions live so you can get a chance to talk to me live. All right, now jump into Robert Kiyosaki after Dave Ramsey. Again, he focuses on, I don't want to say a diverse range of assets, but different assets. So he likes real estate, he likes businesses, and he likes commodities. And he believes in direct control over the investments. And if you think about it, like Warren Buffett, arguably the most famous investor in the world, he says that he doesn't buy stocks. Warren Buffett doesn't buy stocks, which sounds sort of ridiculous. He says, I buy companies, I buy businesses. They just happen to be public. And so when you think about it from that perspective, Robert Kiyosaki is talking about buying businesses. Warren Buffett buys businesses, not stocks. They buy businesses. And then also there's the real estate edge as well. Now, for long-term wealth building, Dave Ramsey, again, doesn't like debt. Robert Kiyosaki does like debt. We're going to break that down. But let's just go ahead and look at a couple scenarios here so we can sort of dig into this. And I do want to say, first of all, I was on a show with Robert Kiyosaki, and we talked about Dave Ramsey. And Robert Kiyosaki said that actually Dave Ramsey is right for most people. And that's the key piece there. That's the nuance. For most people. What does that mean? He was saying that Dave Ramsey and him telling everybody, don't use debt, he's right for most people. And the reason why is because most people don't have the financial education, the financial mindset, the experience to use debt properly. Remember, because risk is in the investor, not the investment. And so I liken it to fire, right? So debt is leverage, and leverage is dangerous. Leverage can help you build wealth much faster, but can also help you lose wealth much faster. I liken it to fire because with fire, I can warm up my house. But if I don't contain that fire properly, I'll burn my house down. If you have kids, you know this, but you don't want kids to play with fire. Why shouldn't kids play with fire? Because they're not old enough, they're not experienced enough to know how to handle it. As you get older, you play with fire all the time. I light my barbecue every night to cook steaks. I light my fireplace right now. It's wintertime. And so we use fire all the time, but I can use it responsibly. But Robert Kiyosaki was making the point that most people have not built up their financial education to the point in which they're responsible enough to use debt. So he's right. And he says Dave Ramsey is right for most people. But I don't want to be like most people. I want to be above average, and so I need to learn how to use fire. I don't want to eat cold salad every day. I want to be able to cook my steak, and so I had to learn how to use fire, and you should also learn how to use debt. Now, why should you learn how to use debt? Well, one, as I said, that leverage helps us grow faster, but two, most importantly, most people don't understand the game of money, if you'll call it that, right? Tony Robbins wrote a book called Money, Master the Game, and that is if you want to master the game, you have to understand money. And so the first step is to understand that we are in a debt-based monetary system. Most people don't even know what that means. And if you don't know what that means, then you shouldn't use debt. But what that means is that all money is created through debt issuance. So, we talk about the meme of the Fed printing money printer go burr. That's not how it works. Money is created into existence by the issuance of debt. When you go to the bank to get a house, a car, a boat, a motorcycle loan, whatever it is, that loan creates the money. It's a money tree. Instead of going to the backyard and pulling money off the tree, I just get on the internet and go to my bank and they give me money anytime I want. As a matter of fact, I just got 6 figures of money from the bank for a new car for my wife. I didn't want to use my money. I wanted the money tree, and they gave it to me. And so we can do that, and that money is created into existence. And so if I want unlimited amount of money, how do I get that? I get it through debt, because we're in a debt-based monetary system. And in a debt-based monetary system, it destroys cash. So Dave Ramsey is all about not using debt and instead saving. But the problem is, in a debt-based monetary system, you need the debt to get rich, and the debt actually destroys the savings. So it's actually opposite. So it works okay if you just want to live a very meager life and grow, and you want to be very safe, and you don't want to take the time to build your financial acumen. You'd rather watch Netflix and chill, I suppose. But if you want to get wealthy, then you have to master the game, like Tony Robbins says, and you have to learn how money works and how to leverage that. So going back to Dave Ramsey first in his corner, again, alphabetically, he goes first. He has something he calls the 7 baby steps. So this is investment philosophy. So if you want to invest like Dave Ramsey, this is what you would do. This is what he'd tell you if you worked with him directly, the 7 baby steps. And let's dig into it. So number 1, save $1,000 for your starter emergency fund. Great. I applaud that. Good job, Dave. You should certainly do that. As a matter of fact, it should be more than $1,000. Obviously, the more the better. But I guess, set that as your first goal. Now, if you don't have savings, you're a slave. And I mean that because if you have no savings, you can't quit your job. If you have a month worth of savings, a month worth of expenses saved up, you could quit your job and then go find a new job in that month period, or 2 months or 3 months or whatever that is. If you have no savings, you cannot quit. You're basically a slave. So I do applaud that. I would like to say, 30 days at least, if not up to 90 days of savings. For me, having gone through what I went through in 2008, I like 12 months of savings, but you figure out what you need to have there. But you need to have that emergency fund. The number's changing, but something about 40%, according to Bankrate, 40% of Americans cannot afford a $1,000 emergency expense right now. All right, so it's a big deal. You should do that. Step number 2, he says to pay off all your debt except for your house. So he says except for the house, but pay off all your debt. He uses something called the debt snowball, which is basically you list all your debts small to large, and you start paying off the smallest one first, and then to the largest one. And that works because of the psychological wins. You start seeing some action. You knock off a couple payments, which makes it easier, and then you can grow from there. I would rather pay off the most expensive debt with the highest payment, not the payment, but the highest interest rate. If I have a 22% credit card and a 6% credit card, I should pay off the 22% debt first, not the 6, but that's his plan. Another stat for you, the average American has $92,000 in consumer debt. That's per Experian, $92,000, almost 6 figures. Then step 3 is now, after you've got $1,000, you've paid off your debt, then you save 3 to 6 months of expenses. And he wants you to put this in an emergency fund to ensure financial security in case anything happens, like a job loss or medical or emergencies, things like that. All right, number 4, now you want to start investing 15%, assuming you've got these things done, start investing 15% of your household income into your retirement. And again, he suggests investing in tax-advantaged retirement accounts like 401ks, Roth IRAs, focusing on mutual funds. Mutual funds is basically, I just give my money to somebody else and they figure it out for me. It's diversified against a whole bunch of assets, and I don't have to worry about it. I don't like that plan. I think with a little bit of education, a little bit of focus, you could do much, much better, which pays massive dividends, 7-figure dividends over the future. But again, I do like it because, again, basically you put no thought, no effort into it, which allows you to go focus on making money. Now, if you're taking that extra time, effort, energy, and focusing on making more money, you might come out ahead. You probably will. If you're instead taking all that extra time so you can watch more Netflix and chill, you're going to get further behind. All right, so you need to consider that. Then finally, 5, you want to start saving for your children's college fund. This is what Dave says, not me. He wants you to save money into an education plan like a 529 plan. For me, I don't want my kids to go to college, specifically don't want them to go to college. So my oldest daughter just graduated. She is not going to college, and I don't expect my youngest to go either. If they want to go, they're welcome to go. They want to be a doctor, an attorney, sure, go ahead. We don't go to college for college's sake. I would rather, I posed the question to my daughter, we'll get back to this with Robert Kiyosaki, but I said, would you rather me spend $250,000 for you to go to a 4 or 5 year college, and when you get out, you can hopefully get a job for $50,000 a year, or would you rather I use the $250,000 and buy you real estate with it that pays you $50,000 for the rest of your life? She said, I like the real estate option. I said, good choice. Right, and so that's what we're doing. Anyway, keep going. Number 6, now you start to pay off your home early. His goal is to become completely debt-free by paying off the mortgage early. Now, this, again, I don't like this, and the reason why I don't like this is a couple of reasons. One, by writing that off, or by paying that debt off, I don't have some tax write-offs that I might need, writing off the interest on my debt. But number 2, assuming that I have that debt, about 90% of mortgages are locked in below 5%. I think 40% of mortgages are locked down below 3% mortgage. So if you have a 3% interest and you have a 5%, 6, 7, 8% inflation is paying your debt off. So I have a 30-year loan. So let's say right now, for easy numbers, it's taking $1,000 for me to pay off my mortgage every month. But in 10 years from now, my pay will have probably gone up, and that $1,000 will be more like $600. And in 20 years, that $1,000, because my payment is still fixed at $1,000, it'll be now like paying like $400 a month. And so that inflation is paying off my debt, which is, again, why we're in a debt-based monetary system. They want to inflate away the debt, but it also inflates away my debt. So I would rather invest my money and make 10, 15% and keep my 3% mortgage, unlike what Dave says. But I get it. It's like leverage. If you have no debt, you're a little bit safer off. Number 7, finally, now you build wealth, and then you give generously. I applaud him on that. Giving is a big piece of what I do. I think everyone should be doing it, if not even just for the smallest piece, and start building that. So I applaud Dave Ramsey for that. All right, now let's turn to Robert Kiyosaki. He has 6 points. Let's see if I can get through these. The first one, and this is going to turn everybody upside down on their head. And again, go read the book, Rich Dad, Poor Dad. It was, like I said, probably one of the top 2 or 3 most influential books on my business and investing career. He has one, the rich don't work for money. They don't work for money. Now, there's 2 things in this. So first of all, they don't work for money. They have money work for them. You see, I work really hard for money, and I want my money to work even harder than I do. So I want my money to work hard. And 2, I don't actually work for money, meaning I don't trade time for money. And I think this is probably the biggest thing that holds people back from ever branching out and having big success is most people just can't imagine working without getting paid. They won't do it. You see, the wealthy, like what I've done, is I've worked for years for free, learning new skills, trying new things, developing new strategies in the hope that one day those skills, that time I put in will get me something later. And I'll work for years doing that without getting paid. But see, most people are used to working for an hourly wage, and they can't imagine working for months or years and not getting paid. So rich don't work for money. Number 2, financial literacy. Now, when Kiyosaki talks about financial literacy, he's talking about it's not how much you make, it's how much you keep. You see, rich people think about how much income, poor people think about how much income they have, but it's not about income. It's not about the income. It's about how much you keep that goes into your savings or really builds up your assets. And you need to understand that the difference between assets and liabilities. You see, like most people think like I have my house, but he explains that your house is not an asset. Your house is a liability. Why? Because assets put money into your pocket. Liabilities take money out of your pocket. So just ask yourself for your home, does your house put money in your pocket or out? It takes it out, obviously. Now, if you have a rental property, that puts money into your pocket, right? So there's a difference there. But you really have to understand what that difference is, and really you see that on your balance sheet. So in the book, he breaks down how to use a balance sheet and how to look at the income and the expenses and the assets there. This is the cheat code. This is the cheat code. As a matter of fact, I have a template for a balance sheet. Just go to onemarkmoss.com and you can download it for free. It's what I call the scorecard. You see, everyone's focusing on how much money they make. It's not about how much money you make. In California, you can make $1 million and still be broke. It's crazy. It's not about how much you make. It's about what your balance sheet shows. It's about what your scorecard shows. So I have a free download. You can get it if you want. Just go to onemarkmoss.com, download it for free, fill that out. And if you track that every single month, what gets measured gets managed. If you measure that every month, it will grow. You know, one of the things that Robert Kiyosaki does talk about all the time, really it changed his life after Vietnam, is gold. He talks about buying a gold Cougarand. He owns gold mines and he still loves gold. And he talks about how gold could take off in 2024, which is no surprise. And it's already taking off. As a matter of fact, it's up 20% since October of last year, just about the last year, which is a massive move for gold. I also like gold. I've been buying it for over a dozen years. And I work with a company called Universal Coin and Bullion. They got great prices and they're trustworthy. I would like Dr. Mike Fulgens and his company, Universal Coin and Bullion. And they have a very special offer for my listeners where you can get a silver 1 ounce American Silver Eagle coin with no dealer markup, only $27 each, but they can only limit it at 3. They'll even ship it to you for free with an award-winning gold investment guide if you mention my name, Mark Moss. Give them a call called Universal Coin and Bullion to get this $27 Silver Eagle coin deal today. 1-800-UCB-GOLD. Again, 1-800-UCB-GOLD. Or you can go online to universalcoin.com/Mark Moss. The third one is mind your own business. Okay? So again, the rich focus on their assets. The poor focus on income. How much money am I making? Can I get a higher paying job? They focus on their income as opposed to the assets that they buy with their income. Am I buying the right asset? Is this the right asset to buy at this time? How can I get this asset to go up in value? How can I get this asset to pay me more income instead of focusing on my income? They also understand minding your own business is that talented people are typically poor because they're focusing on, let's say, the improvement. Let's say like McDonald's. They're focusing on how to make a better hamburger and not about building the hamburger business and creating systems around it so it runs automatically, systematically without me. You see, how can I do this better as opposed to how can I build the business to do this for me? The fourth thing is, and this is a big piece that Dave Ramsey just leaves out completely, and it's a massive fail in my opinion. This is back to Robert Kiyosaki. Number 4, the rich understand taxes. Now you have to understand the IRS is your partner, whether you like it or not. They take, depending on your tax bracket and where you live, if you're in the top tax bracket in California, they take about half of your income. They're your partner, 50-50. And so it's a pretty good idea if you have a business partner to understand what your business partner wants, what they're trying to do, and how you can work together with them. And so Robert Kiyosaki talks a lot about using taxes properly and specifically lowering your taxes. It's your single biggest expense. Remember, back to saving 15% to 40% of your income, you can either make more income or you can cut your expenses. Well, one of the biggest ways, if you're going to cut expenses, is cut your single biggest expense, which is taxes. So the way it typically works, and Robert Kiyosaki points out, is that owners earn income, then they spend whatever they want to spend, and then they pay tax on the money that's left over. Whereas employees earn, and then they pay taxes, and then they get to spend whatever's left. It's a big difference. Now, back to Robert Kiyosaki talking about real estate. If you don't want to pay taxes, one of the best ways to not pay taxes is with real estate and businesses. You see, again, they're your partner. So, for example, the government, it's not loopholes. The government has incentives, not loopholes, incentives. Why is that different? A loophole is like a way to get out of something. An incentive is working in alignment with what you want. So, for example, the government needs places for people to live, right? They need housing and apartments for people to live in. So they can't provide that. But if you are willing to do that, if you're willing to buy a house or an apartment building and rent it out, then they'll give you an incentive to do that. They also need employment. As a matter of fact, it's one of the 2 Fed mandates to have full employment. Well, how does the Fed give employment? Or the government? They don't. They can't. But you can if you start a business. So the government wants you. They need you to start a business. And if you do, they have an incentive. They incentivize you to do the things they want, like start a business and buy real estate. That's why you don't pay tax. So you need to learn that. Number 5, the rich create money. I call this wealth creation. You see, Dave Ramsey wants you to save your way to wealth. It's not how it works. You don't save your wealth. We have to create wealth. How do the rich create wealth? How do they create money? Well, it starts with your mind. It starts with your ideas. Robert Kiyosaki talks about it as an infinite return. You have an unlimited amount of ideas that you can have. So it starts with your mind. You have to have ideas. Then you have to turn those ideas into actions, and you need the skills in order to do that. You have to have skills in order to develop that. I call this, I talk about it in 3 different levels of capital. So most people only focus on one form of capital, which is actually the hardest to get and the least effective to use, and that's financial capital. I don't have enough money. It takes money to make money. I can't do anything because I don't have any money. They don't have the financial capital, so they spend all their time there. They think they're stuck there. But it's not financial capital that really matters more. It's actually the mental capital. It's the skills. Or as Robert Kiyosaki says, we create money with our skills. If you have the skills to make more money, and then third is the relationship capital. Do you know people? So I know people who give me opportunities, and I have the skills to back that up. It doesn't take me any money. So it starts with your mind. We can create wealth by having the idea, having the skills to develop that, and then, of course, continue to plant the seeds that continue to grow. Robert Kiyosaki, the 6th one is work to learn, not to earn. So he says that education is more valuable than money. That's the point I'm just making right now. Education is more valuable than money. You see, if I have the education of how to, if I can come into your business and make you $1 million, would you give me $100,000? Like, of course you would. But how could I do that? Well, only if I have the education, if I have the skills in order to do that. So the skills you need to figure out is how to make more money. How do you do that? Well, I want to learn sales, marketing. Sales and marketing, that's the rainmaker. That's how you drive money. I want to learn speaking and negotiating. I need to be able to present myself. I need to present my ideas. I need to have persuasion. I need to be able to negotiate things. And this goes whether you're trying to negotiate with your kids, your wife, or a business deal. And we also need to learn how to learn. I talk about this quite a bit. We need to learn how to learn, and we also need to learn how to teach. We need to do both of those. And so we need to work to learn, not to earn. And this goes back to kind of the first point about the rich don't work for money, right? I'm working to learn because if I learn and advance my skills and make more money, I'm not working for the money. So that's Robert Kiyosaki's 6 points. Now let's break these down a little bit. All right. Now, Robert Kiyosaki, if I compare these two, the big differences are Dave Ramsey is very risk averse. Get rid of all of your debt. Don't use debt, and just put your money into a mutual fund. Just give it to somebody else and let them manage it for you. Pay off all your debt and just give someone else your money. And as Robert Kiyosaki said, that works great for most people because most people aren't smart enough, and I would add, don't have enough motivation to do anything else. They would rather just have no debt, have no risk, give someone else my money, and so I can just watch Netflix and chill every day. But for those of us like me and you who want more from our lives, then we need more. And how do we get more? Well, then we're going to have to spend more time to learn, to build our skill set. And once we've been able to learn and build up our skill set, our mental capital, as I call it, then we learn the difference of good debt and bad debt, then we can use debt in order to build our assets. We can start businesses and we can buy real estate. And this doesn't have to be risky. As a matter of fact, I've started dozens of businesses and I've never once taken a large amount of capital. You see, when you start service-based businesses, it doesn't require capital. It only requires your time and your skill set. So for example, you could probably go start a pressure washing business. You can go to Home Depot, buy a pressure washer for $300. You could probably even rent one. And you could probably go to your neighborhood or go to a wealthy neighborhood with some big houses, and you could probably charge $200 to $400 to pressure wash their driveway. And you could build that up pretty quickly. It doesn't take money, it takes time and skill set. Now, the bigger your skill set and the bigger market you can apply it to, the more money you can make. But I like Robert Kiyosaki's approach. I would rather spend the extra time, effort, energy. I want to increase my income. I want to grow my wealth faster. Understand that it takes me more time. But If you're the Netflix and chill kind of guy, you want to live in your parents' basement, watch Netflix, and eat Cheetos, then go for the Dave Ramsey approach. But maybe I'm too harsh. Let me know what you think. I'd love to hear from you. Come to my live event and tell me. We're going to do a live Q&A. I'm going to show you this reverse market crash, how it's going to affect the world, and what you could or should be doing about it. So come hang out. Check it out. Go to onemarkmoss.com or go.onemarkmoss.com/reverse, go.onemarkmoss.com/reverse, and hope to see you there. If not, hit me up on social media at onemarkmoss, and that's what I got. Thanks so much for listening.